If you are making either of these two mistakes when you're trading options, you are missing out on gains and you're really putting yourself at risk that you don't really have to. Make sure you hit like and subscribe to our channel here. And we're going to talk about two errors that happens when trading options. And look, trading is an easy way to go broke if you do not adhere to good risk management protocols. Now, options trading, it's great, right? It allows you to leverage a fraction of the amount that it would take to get involved in trading a stock. So when we have good risk management, we cut down our losses, we protect our trading account. But the issue is that this essential part of trading is often ignored. A few bad trades, your whole trading account could be wiped out. And honestly, this is something that happens to a lot of traders. The leverage when you trade options can magnify your losses if you do not take steps to avoid it. And in this video, we're going to show you how to use risk management when you trade options that can actually prolong your trading career. Taking on risk is how we make money when we're trading anything, including options. So one of the rules that we hear in regards to risk is not to put up more than 2% at any one time on a trade. But what do a lot of traders do? An option trader may think this is a can't-lose trade, and they risk multiples of that 2% general rule. Some traders will look for a simpler approach to risk. Their technique revolves around trading one contract for every single trade. But is that a good method to take? Both of these have risk exposure issues that if you don't address them, they can lead to unreasonable risks that do not have to occur when you trade options. See, the one big safety feature of trading options is that your potential loss is only the amount of the premium that you paid for the options contract. It's totally defined, right? It's fairly simple to follow the lead of successful traders and properly protect your downside, but the problem is many don't do it. Now, the multiples of 2% risk, the issue by itself, that's not a problem, right? The problem is when traders use huge risk on one or two positions as you look for that home run win. Now, at NetPicks, we've seen traders buying options using 15 to 20% of their account size. Now, this is a disaster. It's just waiting to happen when you roll that dice. They're just looking for a big win. Now, we all know that a string of losing trades is the reality. It's going to happen. There's also going to be winners, and we're also going to have break-even positions, right? It's all wrapped up in there. So in this example here, I want you to imagine that you're bullish on XOM, and you bought an in-the-money call option with 17 days left to expire at $3.15 or $315 a contract. That $315 is the maximum that you can lose if this trade goes against you. So if you're trading a $5,000 account and you decide that you're going to risk 20%, you're risking $1,000. That's what you're okay with. So you do the quick math and you realize you can buy 3 options contracts. Well, the payoff, that could be pretty good if you win. But if you lose, you're going to end up losing up to $945 in what you paid. A few trades like that, and you can see how fast you're going to deplete your trading account. So how about we take that same level of risk, your 20%, and spread it around across multiple trades instead of putting all your eggs in that one basket. You're going to have a more diversified options portfolio in instruments and sectors. And you could also use more advanced option strategies outside of simple calls and puts. Now, those that trade one options contract. So you may decide that your risk tolerance only allows you to trade one contract. Problem is that you ignore the reality that the cost to trade depends on the underlying stock. So in this example here, let's compare buying an in-the-money call option on Tesla with 31 days to expiration. The asking price is $20.85. That's per share. Remember, there's 100 shares of stock in one contract, so it's going to be $2,085 to get you one options contract. Now let's compare that to an in-the-money call option on Citigroup. The same 31 days to expiration. One contract is going to cost you $254. It's a fraction of one contract of Tesla. So remember, this is the premium that you're going to pay to have the right to purchase either of these at some time in the future at the strike price that's related to the cost that you paid. It's also the maximum that you can lose on the trade. So if you have a $5,000 trading account, well, you can see that using that one contract rule, Tesla loss would cut your account in half if that was a full loss you took. Well, it's obvious that the one contract rule is not going to work. In fact, with Citigroup, you would not be maximizing the potential rewards by using such a simplistic risk strategy. So in our options trading program, we suggest that a trader set a dollar amount for risk that is uniform across all trades. And it could be $200, it could be $2,000, but that amount's going to apply to every single trade. So if you decide on $2,000, well, you would not be able to take any Tesla options positions in our example, but you could hold 7 contracts of Citigroup. For many of our newer traders, this set dollar amount is a breakthrough for them. Plus, it helps them understand what their risk is really costing them. So if they want to increase their risk, they can. They just need to adjust their dollar amount accordingly. That's it. So how do we approach risk? Well, everyone's unique, right? There's no cookie cutter. Everyone's got different funding amounts. Everyone has different risk tolerance and skill level. So this is just an example of how our in-house team handles risk. First, risk no more than 50% of the account at any one time is paramount. This amount is going to be spread across multiple positions and strategies. So if you're trading a $15,000 account, no more than $7,500 will be in play at any one time. The second stage is risking no more than $500 on any single trade. So that means that some trades may have 5 contracts. Another trade may have 10 contracts. Now that account size is going to make a difference here, right? You got to determine what your figure is going to be. We look at 2 to 3%. Some people risk 6%. It all depends on a trader. Now, I want you to keep in mind, this is the maximum risk. When we go back to Tesla, that maximum risk is over $2,000. What? That doesn't mean we're going to let our options trade take a full loss. This is because of the trade management approach that we take, and we'll cover that at a later date. Third, we use a mix of option strategies. It's going to include the basic calls and puts, but we'll also add in some spreads and a couple of different sectors. We also use a strategy that allows us to profit in 5 different ways on one position. Now, look, risk management, it's always important when trading options, right? It's especially crucial when you're just starting out. If you use too large a position, you run that risk of depleting your account before you have a chance to see any profits. Additionally, by only trading one contract at a time, you ignore the price of the underlying stock, and you could be taking too large a risk or not maximizing the potential of the trade. A better strategy, use a small percentage of your account per trade, set a dollar amount that you're willing to risk on each option. This is going to ensure that your trades are profitable in the long run and limit losses if things don't go as planned. And to get started with options trading, we have a free 8-minute options cookbook guide you can download. And in that, you're also going to learn how we can generate profits 5 different ways in only a few minutes a day. Make sure you hit like, hit subscribe. We'll talk to you soon.